Hello everyone. Hope your preparation is going good. In the previous video, I've revised 12 accounting standards. In this video, we'll be covering 3 different accounting standards. The material which I'll be using for discussing all that, I've shared in the Telegram group. So if you want to access the material, you can join the Telegram channel through the link provided in the description box. So without wasting much time, let us get into the video. Let us move on to accounting standard 25. So this standard deals with interim financial reporting. See, normally when a company reports the financials like balance sheet, P&L, cash flow statement, notes to accounts, they do it on yearly basis, which is called annual financial reporting or annual financial statement. But sometimes some companies have to report the financials for a period of less than 12 months. And if you're reporting for a period of less than 12 months, we can call them as interim financial reporting. And normally, in case of listed company, they're supposed to prepare quarterly accounts. And if they're preparing quarterly accounts, can we call it as interim financial reports? Correct. Now, when you are preparing interim financial reports, company has two options. See, either they can prepare complete set of the financial statements, or you can prepare condensed set of financial statements. And when I say complete set, it will be complete balance sheet, complete profit and loss account, complete cash flow statement, complete notes to accounts. But instead of doing that, some companies, what they do, they prepare condensed set of financial statement. And when we say condensed, can I say this is more like summarized form or extract? And if you are preparing extract, that includes condensed balance sheet, condensed P&L, condensed cash flow statement, and there is something called a selected explanatory notes, which means instead of preparing notes to accounts for every single item, you prepare notes to accounts only for important items in your accounts. Is that clear? Now, okay, so this is the main thing. So while preparing the condensed set of financial statement, so we should ensure that the minimum headings and subheadings are maintained. However, you need not provide minute details. Okay, so with this we complete the first topic of ACE 25, the meaning of IFR. Okay, now what is the legal status of accounting standard 25? Now, interim financial reporting is not mandatory for all the companies. Remember that it's not mandatory. But if you're a listed company, then you must prepare IFR. So the point you have to understand, AS 25 is not asking the company to prepare IFR. So you are preparing IFR because of SEBI regulation. But if you are preparing IFR, then you must follow what accounting standard 25. So the point you need to understand, AS 25 is not mandatory. But if you are preparing IFR, then AS 25 has to be followed. Okay. And this accounting standard 25 mainly focuses on two different aspects. One is recognition, the other one is measurement. So you take off any accounting standard, there are 4 different aspects normally we deal with. Can I say recognition, measurement, presentation, disclosure? Now let's say accounting standard 1. The main focus is on what? Disclosure. Accounting standard 2, valuation of inventory, measurement. Accounting standard 13, valuation of investment, measurement. Just any standard you discuss about, either will be focusing on recognition, measurement, presentation, and disclosure. Now, this accounting standard 25 mainly focuses on either recognition and measurement. These are the two aspects covered. Now, see, when you are doing recognition and measurement, there are two different approaches available. Let's take an example. Let's say you are preparing accounts for quarter number 1, first quarter. During the first quarter, let's say we have a bad debt, 12 lakh rupees. Now, my question is, in the first quarter, when you're preparing profit and loss account, will you recognize the entire 12 lakh rupee bad debt, or will you spread that 12 lakhs over all the 4 quarters? It's like 3 lakh rupee, 3 lakh rupee, 3 lakh rupee, 3 lakh rupee. So the entire bad debt, should I book it in the first quarter only, or should I spread over 4 quarters, 3, 3, 3, 3? Okay. Now, if you are recognizing the entire 12 lakhs in quarter 1 itself, it is called as a discrete approach. So when I say discrete approach, what does it mean? You will be treating that interim financial report as a standalone period. So you will not treat that quarter as a part of full year. You will treat that quarter as a part as an entire year. So what I'll do, I'll book the entire 12 lakhs bad debt in the first quarter itself. If I do that, it's called a discrete approach. So instead of recognizing 12 lakh, if you put 3 lakh, 3 lakh, 3 lakh, 3 lakh, which is if you treat the quarter as a part of the complete year, as a part of a complete year, that approach is called integral approach. Okay. So theoretically, there are two approaches. So when I say integral approach, you will treat the interim financial report as a part of the full year. Whereas in discrete approach, you treat the interim period as a standalone financial period. Okay. And practically, accounting standard 25 supports only discrete approach. We don't follow integral approach. We follow which approach? A discrete approach only. Which is as and when the transaction arises, it has to be recognized in that quarter only. You cannot take it to the next quarter. Is that clear? Okay. So this is the point. So in our example, now 12 lakh rupee bad debt is arising in which quarter? First quarter. If it is arising in first quarter, you have to recognize in first quarter only. You cannot take it to second, third, and fourth. So based on accrual concept, as and when it arises, it has to be recognized in your books of accounts. Is that clear? Okay. Now let us take an example. The same example that I've discussed here. There is a huge bad debt of 12 lakhs in quarter one. If you recognize only 3 lakhs in quarter one, it's called integral approach. If you recognize the entire 12 lakhs now only, it's called a discrete approach. And which approach is recommended? Which approach is recommended? AS25 is more inclined towards a discrete approach only. Discrete approach. We don't follow integral approach. Which is you will treat that interim period as a standalone period. Don't treat that as a part of the full year. Treat it as a separate period. Separate period. Is that clear? Okay. Now, see, in simple words to understand, if you are getting bad debt in year one, can you defer it to second year? No, right? Same way, if you are getting bad debt in quarter one, you cannot take it to quarter two. So quarter one bad debt, you should book it in quarter one only. Is that point clear? Okay. Now, so the final conclusion that you need to keep in mind, all expenses, incomes, assets, liabilities are recognized on discrete approach, and you need to treat the interim period as a standalone financial statement. Okay. However, there is only one exception for that. That exception we'll discuss a little later. Okay. Now let's move on to the next point. Form and content of financial statement. This can be a theoretical question. Okay. Form and content of interim financial statement. See, if you are preparing complete set of financial statement for the interim period, then you need to ensure that whatever format and content you follow for interim period should be same that of annual financial statement. Is that clear? So whatever format I follow for AFS, same format should be there for IFR also. Next one. So instead of preparing complete set, if you are preparing condensed set, then you should maintain minimum heading and subheading should be retained, and you need to prepare selected explanatory notes. And when I say selected explanatory notes, you have to prepare notes to accounts only for which item? Important item. Next. If the enterprise is presenting basic EPS and diluted EPS on the face of P&L as per AS 20. Now, as per accounting standard 20, you need to calculate what? Basic earnings per share, diluted earning per share, and these two has to be reported on the face of financial statement, correct? On the face of P&L account. Now, if you are presenting that in the annual financial statement, you should present that in IFR also. So let's say you are preparing accounts only for one quarter. For that one quarter, you need to find out basic EPS and diluted EPS, and you need to report that for that quarter P&L face. Is that clear? Next. See, when you are preparing annual financial statement, if you are doing consolidation, let's say you are having holding company and subsidiary company relation, when you are preparing annual accounts, you have to prepare consolidated balance sheet and consolidated P&L. So if you are doing consolidation for annual financial statement, then you should do consolidation even for interim financial statement. So these are the 4 points to be kept in mind with respect to the form and content of IFR. Now, apart from that, here I told you selected explanatory notes. So you should give some explanatory notes for important items. What are the selected explanatory notes? So I've given some theory points. You can just go through that. All these are self-explanatory. And these are some important aspects for which company must present explanatory notes. Is that clear? Okay. This point you can just go through. So I'm not spending much time on this. Okay. Moving on. Oh, there is one question here. We'll just discuss that question. Question number 1. Balaya Limited reported a profit before tax of 4 lakh for the third quarter. So for which quarter it is? Third quarter. On inquiry, you observe the following. Give the treatment under accounting standard 25. Now listen. So they gave you profit of how much? 4 lakh for quarter number 3. Okay. First one. Dividend income of 4 lakh received during this quarter has been recognized only to the extent of 1 lakh. Can I say it's a mistake? If you are receiving 4 lakh dividend, you should recognize how much? 4 lakh. But they are recognizing only 1 lakh. So because of that, the profit would have come down. So what should I do now? To find out the correct profit, I should add back the difference of 3 lakhs. I hope all of you are clear. Next point. 80% of sales promotion expenses of rupees 15 lakh incurred in the third quarter has been deferred to the fourth quarter. See, if you are incurring sales promotion expense in third quarter, you should recognize in which quarter? Third quarter only. But what they are doing, 80% of that is nothing but 12 lakh rupee, they are deferring to the next quarter. So, because you are deferring it to the next quarter, in the third quarter, can I say unnecessarily your profit is going up? So, instead of booking 15 lakh, you are booking only 3 lakh rupee expenditure. Because of that, the profit has gone up. So, what should I do now? To find out the correct profit, I will minus 12 lakh. I hope all of you are getting that. Next. In the third quarter, the company changed the depreciation method from WDV to SLM. And can I say, as per accounting standard 10, when you change the method of depreciation, that is a change in accounting estimate. And when there is a change in accounting estimate, the impact has to be prospective, that is from the period of change. Okay. This resulted in excess depreciation of 12 lakh and the entire amount has been debited in third quarter only. Okay. Now, see, when you are changing the method of depreciation, if you are getting any extra depreciation, should we recalculate from the beginning or should I do it prospectively? Prospectively. And that's what the company is doing. They're doing it prospectively in the third quarter itself. And if they're doing the entire amount in the third quarter itself, can I say that is correctly done? And since it is correctly done, no need to do any rectification. This can be ignored. Is that clear? Next, point number 4. 2 lakh rupee extraordinary gain received in the third quarter was allocated equally to third quarter and fourth quarter. See, we got a gain of 2 lakh, but you are recognizing only 1 lakh. Because of that, the profit would have come down. So what should I do now? I will add back 1 lakh. Okay. Next, point number 5. Cumulative loss resulting from change in the method of inventory valuation. Okay. Was recognized in the third quarter of 3 lakh. So how much loss you are recognizing in the third quarter? 3 lakh. But out of this, 1 lakh loss relates to previous quarter. So the previous quarter's 1 lakh loss you are booking in this quarter. Because of that, unnecessarily this quarter profit would have come down. So since the profit has come down, so what am I going to do? Add back. So I will add back this 1 lakh. And finally, sale of investment in the first quarter. When did we sell it? First quarter. And that resulted in 20 lakhs gain. And the company had apportioned this gain equally over 4 quarters. So what they should have actually done, the entire 20, they should recognize in quarter 1. But instead of that, they're recognizing 5 lakh, 5 lakh, 5 lakh and 5 lakh. Because of that mistake, in the third quarter, unnecessarily 5 lakh rupee gain got recognized. Because of that, the profit has gone up. So what should I do now? Minus 5 lakh. Do all that calculation. That will give you correct profit of quarter number 3. So can I say 4 plus 3, 7 minus 12. So that is minus 5, minus 4, minus 3, minus 8. So finally, how much is the correct answer? 8 lakh rupee loss should be the correct answer for quarter number 3. I hope all of you are clear with this. Okay. And there is one more very important concept. See, normally, when you are following accounting standard 25, we follow discrete approach, correct? But there is one exception to that, that is provision for tax. See, when you are finding out provision for tax, we don't follow discrete approach, we follow something called integral approach. And when I say integral approach, we treat the quarter as a part of the entire year. So what we will do here, first we will find out something called a weighted average rate of tax. So I'll call it as weighted average annual tax rate. Now, how do you find out this weighted average annual tax rate? estimated tax for the entire year divided by estimated total income. So you need to find out estimated tax of the entire year divided by estimated total income into 100. That will give you what? A weighted average tax rate. And that weighted average tax rate has to be applied on each quarter profit to find out provision for tax. Which means while finding out provision for tax, you're not treating every quarter as a separate period. You're treating that quarter as a part of the entire financial year. And that is the reason in the denominator, what you're taking what? Estimated total income of the entire year. And in numerator, estimate tax of the entire year. Let's take an example to understand this. Look at example number 2. An enterprise estimates annual income. So how much is the annual income? 10 lakh. That is in denominator. Okay. And they are given you tax rate for the first 5 lakh, 30%. So can I say 1.5 lakh? For the next 5 lakh, 40%. So can I say 2 lakh? So 5 lakhs, 30%. And for the remaining 5 lakh, 40%. So the total estimated tax is going to be 3.5 lakh, which will be the numerator. So 3.5 lakh upon 10 lakhs into 100. Can I say we are getting 35%? This 35% is called a weighted average tax rate. And this 35% you apply on each quarter to find out a provision for tax. Now tell me, for quarter number 1, it will be 75,000 profit. In that 35% will be provision. For quarter number 2, 2.5 lakh in the 35%. For quarter number 3, 3 lakh 75,000, 35%. So like that, first you find out the rate. And when you're finding out the rate, you're treating that quarter as a part of the complete year. So that is what it's called integral approach. I hope all of you are clear. So with this, we have done with a quick summary of Accounting Standard 25. Yeah, let us move on to Accounting Standard 20. This standard deals with earnings per share. When we say earnings per share, it means earnings available for one equity share. So can I say in the numerator, it should be earnings. In the denominator is supposed to be number of equity shares. And that is going to give you earnings available for one equity share. Now the question arises, what is the meaning of earnings? And when you're taking the number of equity shares, how do you calculate that number? Okay, that is the main focus of this particular standard. Okay. This standard focuses on two different aspects. One, how to calculate EPS. That is nothing but determination. Second, presentation of EPS. So once you calculate the earnings per share, that earnings per share will be presented on the face of profit and loss account. Very, very important. So it is not disclosed inside the P&L. It will be disclosed on the face of the P&L. And there are two different types of EPS that you'll be learning. One is called basic earning per share. The other one is a diluted earnings per share. Now, what is all that? As we proceed in the standard, we'll try to understand. Okay. First one, let's take an example. Calculation of EPS. Look at the example given to you. EBIT is given, EBT, profit after tax. From the profit after tax, they're transferring some amount to general reserve. Can I say that general reserve belongs to the shareholders, equity shareholders? Then there's a transfer to statutory reserve, proposed equity dividend, proposed preference dividend. Okay. Now, when you are taking the numerator, what should I take? Profit available to equity shareholders. That should be the numerator. Profit available to equity shareholder. In our example, what is your profit after tax? 70 lakh. Out of that 70 lakh, how much is the preference dividend? 10 lakh. So from the 70 lakh, you remove 10 lakh and that is going to give you profit available to equity. Because the general reserve, statutory reserve, equity dividend, all that belongs to equity shareholders only. Which is when you are finding the numerator, what is the formula? From PAT, from the profit after tax, you minus the preference dividend, that will give you profit available to equity shareholders. That should be the numerator. Okay. And in the denominator, what you're going to take? So in the denominator, it's given to you number of equity shares on 1st of April, 2 lakh. So can I say the beginning of the year, 2 lakh shares are there. 2 lakhs into, can I say this shares will be outstanding for the entire year. So I'll consider the period weightage. So 2 lakhs into 12 by 12, 2 lakh. Okay. Next, on 1st of September, 20,000 shares were issued. So I'm issuing 20,000 shares. I will add that. But the 20,000 shares that I'm issuing, when am I issuing? 1st of September. Which means these shares are not there for the entire year. So these shares are there only for 7 months, can I say? Correct? So they are not there for April, May, June, July, August. So during the year, the 20,000 shares were outstanding only for a period of how many months? 7 months. So I'll take 20,000 into 7 by 12. Simplify that. So can we say, so take 20,000 into 7 by 12, 11,667 approximately. That will be added. Okay. Later, on 1st of February, 10,000 shares are bought back. And if the shares are bought back, the number will come down now. So what should I do? Minus 10,000 shares. But when are you buying it back? February. And if you're buying back in February, can I say February and March, 2 months I'm supposed to remove. So these shares were there for how many months? 10 months. They are not there for how many months? 2 months. So since they are not there for 2 months, I'll calculate 10,000 into 2 by 12. So can I say 10,000 into 2 by 12 will give me 1,667 minus that. So can I say 2 lakh plus 11,667 minus that will give you 2 lakh 10,000. And this 2 lakh 10,000 is called as a weighted average number of equity shares. What is it called? Weighted average number of equity shares. So the final formula for basic EPS. So how do you calculate basic EPS? Profit available to equity shareholders in the numerator divided by weighted average number of equity shares. This is the final formula. Is that clear? And when I'm taking the profit available to equity shareholders, how do you get that? From profit after tax, only preference dividend should be eliminated. That's all. Divided by when you're finding out that weighted average number of the equity shares, you should consider the period weightage. In our example, opening balance is there for the entire year. Now, try to understand the logic. Why am I taking this period weight? So, in our example, you are issuing 20,000 shares. So, this 20,000 shares, when I issue, I get the money. And that money is utilized only from September onwards. If I'm using the money only from September, you'll be earning the profit only from September, which is in a numerator. When I'm taking the profit, that profit will be there only from September onwards. So with respect to these 20,000 shares, the profit is earned only for 7 months. And since the profit is included only for 7 months in the numerator, in the denominator also, when you are taking the number, I should consider only how many months? 7 months. So I hope you are understanding the logic. Okay. And that is the reason we are considering the period weightage and multiplying that. Is that clear? So the final conclusion, what is the final formula for basic EPS? Profit available to equity shareholders divided by weighted average number of equity shares. And when you're finding out the weighted average number, we should consider the period weight of that particular equity shares. Is that clear? Okay. Which is for example number 1, the final formula will be, what is the final answer? 70 lakh. From the you remove 10 lakh. So the numerator is going to be 60 lakh. Divided by denominator weighted average number will be 2,10,000. Simplify that. That will give you basics earnings per share. Is that clear? Okay. Now let us move on to example number 2. Second example, you see. Calculate EPS from the following information. Okay. PAT is given to you 80 lakh. Preference dividend is 5 lakh. So can I say numerator will be 75 lakh, 80 minus 5 will give you 75 lakh. Okay. Number of shares on April 1st, 3 lakh shares of 10 each fully paid up. Okay. And on 1st of October, 1 lakh shares are issued. Face value is 10 rupee, but how much is only paid up? 5 rupee. Okay. Then on 1st of March, 45,000 shares are issued. And what is the face value? 10 rupee. How much is paid up? 4. Find out the EPS. Now listen carefully. 1st of April, opening balance. How many shares we have? 3 lakh. Okay, so I'll take 3 lakh. And can I say this 3 lakh shares are there for the entire year? So I'll consider the period weightage 12 by 12 into what is the face value? 10 rupee. Paid up value also 10 rupee. This is called a paid up value weight. So we need to consider period weight also, paid up weight also. So when I do that, how much I'll get here? 3 lakh. Next, on 1st of October, I'm doing a fresh issue. And when I'm doing fresh issue, how many shares we are doing a fresh issue? Just see here. We are issuing how many shares? 1 lakh. So I'll take 1 lakh. These 1 lakh shares are issued on October. So can I say that they're only for 6 months into 6 by 12? And in that, 10 rupees paid up or only 5 rupees paid up, 5 rupees. So the face value is 10 rupee. However, paid up value is only 5 rupee. So it is like, understand the logic here. 1 lakh shares, even though the face value is 10 rupee paid up, sorry, 10 rupees, we got only 5 rupee. So can I say effectively, it's like 1 lakh shares of 5 rupee paid up is nothing but 50,000 shares of 10 rupee paid up, equal in number. See, when I do 1 lakh into 5 by 10, indirectly, what do I get? 50,000. So it is like 1 lakh shares of 5 is equivalent to 50,000 shares of 10. And those 50,000 shares are there for only how many months? 6 months. So effectively, can I say it's equivalent to 25,000 shares? And that is what I should add. Is that clear? Apart from that, again on 1st of March, there is one fresh issue happening. How many shares are issued here? 45,000 shares are issued. And these 45,000 shares are there for only 1 month. So I'll take 1 by 12. Paid up values 4 rupee, face values 10 rupees. Simplify that, please. So can I say 45,000 into 4 by 10 will give you 18,000, into 1 by 12 will give you 1,500. Add all that, and that will give me weighted average number of equity shares. This will be my denominator. Is that clear? And numerator we already know. So what is the numerator? We know PAT 80 lakh. From that 80 lakhs you remove preference dividend 5 lakh. So can I say numerator will be 75 lakh. So the final formula, profit available to the equity shareholders 75 lakh divided by weighted average number of equity you do, and that should give you basic earning per one share. Is that clear? Which is whenever you are calculating basic EPS, there are two different weights I should consider. Period weight also, paid up value weight also. Is that clear? Okay. Let us move on to the next example. Point number 3. Calculate EPS from the following. Okay, numerator is given to us already. Profit available to the shareholders 45 lakhs. So numerator we know 45 divided by number of shares at the beginning. So 7 lakhs, can I say into 12 by 12? Plus on 1st September 2015, one asset is purchased costing 5 lakhs. Consideration is settled by giving 50,000 shares of 10 each. And when are the shares given? 1st of October. Now, when I'm adding the number of shares, how many shares we are adding? 50,000. And that 50,000 shares, should I consider from October or should I consider from September? Now, if you look at the example, when is the asset purchased? September. When are the shares given? October. Now, should I consider October or September in the denominator calculation? Now, try to understand the logic. If the asset is coming in September, can I say we started using it from September? If you started using from September, profit also is generated from September, which is in the numerator, profit will be there from September, which means in denominator also, I should take the number from September only, which means even though the shares were issued on October, I don't consider October. You need to consider date of receiving the asset. And because the asset is received on September, so how many months I should take here? 7 months should be considered. I hope all of you understand. So the point here, whenever the shares are issued for buying an asset, we need to consider the date of receiving the asset and not the date of issue. Okay. Now simplify that and find out the weighted average number. So can I say denominator will be, so much you get? Can I say 45 lakh will be in the numerator, divided by 7 lakh 29,167 approximately. Simplify that and that will give you basic EPS. Okay. So what is the most important point here? Whenever you buy any asset, you need to look at the date of receiving the asset. Okay. Not the date of issue of shares. Now let us move on to the next important discussion. Fourth one. Explain how EPS will be disclosed in the books of accounts in the given case. They gave you last year profit 30 lakhs, current year profit 40 lakhs. Number of shares in the last year 10 lakh. During 15-16, that is in the current year, on 1st October 15, can I say exactly in the middle of the year, bonus shares were given in the ratio of 1:1. So can I say if 10 lakh shares are there, bonus also will be 10 lakh shares. Okay. And that 10 lakh shares, when are they issued? Exactly in the middle of the year. Now calculate EPS. It's a very important discussion. You have to focus carefully. Now, focus carefully. In the last year, what is my profit? Can I say for 14-15, when I calculate basic EPS, we know profit is 30 lakh divided by how many shares are there in the last year? 10 lakh. So 30 lakhs by 10 lakh, if I calculate, last year EPS will be how much? 3 rupees. Is that clear? Now, let us come to current year, 15-16. 15-16, when I calculate basic EPS, what is the profit given in the question now? 40 lakh. 40 lakh divided by, so at the beginning of the year, 10 lakh shares are there. That 10 lakh will be there for the entire year. So 10 lakhs into 12 by 12 plus how many bonus shares are given? 10 lakh. 10 lakh. And this 10 lakh bonus shares, will be assumed as if it is there from the first day of the last year. Very, very important. So even though the bonus shares are happening in the current year, we assume that these bonus shares are there from the first day of last year. So if it is there from the first day of last year, when you are taking the weightage, you should take it as 12 by 12. Because in the current year, numerator, you are taking profit of only 12 months. In numerator, if profit is 12 months, in denominator, number also should be taken for 12 months only. So whenever there is a bonus issue in the question, we assume that the bonus shares are there from the first day of last year. With that assumption, we calculate it. Now, can I say this is the opening balance? This is the bonus issue. Now, if I calculate the EPS, that will give me 40 lakh divided by 20 lakhs, 2 rupees. Correct? Okay. Now, what is the EPS we reported in the last year? 3. What is the EPS we are going to report now? 2. Now, if somebody looks at the final account, so what do they think? Last year EPS is 3. This year my EPS has become 2. So if a layman looks at your books of account, they will think that since the EPS is coming down, they will assume that the company performance is actually going down. Correct? But if you observe properly, company is actually improving because, sir, when you make a bonus issue, money is not coming now. A bonus issue, there is no new resources coming to the company, which is whatever money we have in the last year, we have same money now also, which is with the same resources. So last year my profit was 30 lakh. With the same money, this year my profit has become 40 lakh, which is, can I say, actually there is improvement in the performance. Your 30 lakh profit has become 40 lakh with the same amount of resource. So what is the improvement here? 10 lakh is the improvement divided by what is the old year profit? 30 lakhs. So logically, there is 33.33% improvement in the performance. Correct? But if I report 3 rupees and 2 rupees, that is not reflected. So people will assume that the company performance is going down. But in reality, company is actually performing better. Correct? So now what we are supposed to do, whenever there is bonus issue in the question, in addition to current year basic EPS, company should also calculate restated EPS of the last year. So what should they calculate? Restated EPS of the last year. So for that, what I'll do, I'll take the last year profit in the numerator. How much is that? 30 lakh divided by opening balance 10 lakh. And as if these bonus shares are there in the last year also, we'll assume that and we'll restate the EPS. So that will give me 30 lakh divided by 20 lakh. So how much will be the restated EPS of last year? 1.5. Now, if somebody is comparing current year EPS of 2, that 2 I should not compare with 3. So the 2 rupees should be compared with restated EPS of last year. And if I compare 2 and 1.5, what is the improvement in the performance? 50 paise. 50 paise upon last year EPS 1.5. So 50 paise upon 1.5, can I say 33.33% improvement? And that is what is reflected exactly. I hope all of you are getting that. Which is whenever there is bonus issue in the question, in the current year, you must calculate current year basic EPS and also last year restated EPS. And the comparison always should happen between current year basic and last year restated. That is the correct comparison. I hope all of you are getting that. And we have an assumption, bonus shares are assumed to be there from the first day of previous year. And based on that assumption, we'll calculate the weighted average number of equity shares. Is that clear? Okay. So with this, we are done with example number 4. Yeah, let us move on to the next question. Calculate EPS in the following case. Last year profit is 60 lakhs, current year profit 80 lakhs. Number of shares outstanding at the beginning of the year 10 lakhs. So current year beginning we have 10 lakhs. So we assume the same 10 lakh was there in the last year also. So can I say first for 14-15 the basic EPS will be 60 divided by 10 lakhs, 6 rupees they would have reported. Okay. On 1st July 2015, a building costing 8 lakh is bought for which 80,000 shares are given on 1st of October. So even though the shares are given on October, since the building is bought on July, I should consider from which period? July only. Okay. Apart from that, on 1st December 2015, company issued bonus shares in the ratio of 1 for every 4. Okay. Taking the opening balance as the base. So what is the opening balance of shares? 10 lakh. For every 4 shares, we are giving 1 as bonus. So can I say for 10 lakh shares, so 10 lakh into 1 by 4, how many bonus shares would I give in? 2.5 lakh. And this bonus shares of 2.5 lakh is assumed to be there from the first day of the last year. Okay. Now you need to calculate basic EPS of last year, adjusted EPS of last year. Sorry, you need to calculate basic EPS of last year, basic EPS of this year, and adjusted EPS also. Okay. Now, whenever there is a bonus issue in the question, we need to calculate last year basic, this year basic, and last year adjusted EPS. Now, let's try to calculate that. First, see last year EPS. So, last year basic EPS will be profit available divided by number of shares. So, how much is the profit in the last year? 60 lakh divided by 10 lakh. So, can I say 6 rupees? This is last year. Now, coming to current year basic EPS. So when I'm calculating current year basic EPS, what is the numerator? 80 lakhs is the profit divided by when I take the number of shares. At the beginning of the year, opening balance is 10 lakh. This is there for the entire year. So 12 by 12 is the first thing. Plus, you are issuing some shares for the purpose of purchasing an asset now. How many shares we are issuing for buying an asset? 80,000 shares. And that 80,000 shares I have to consider from which month? July onwards. So can I say 80,000 shares from July onwards? Can I say 9 months? So I should take 9 by 12. Okay. In addition to that, we are issuing bonus issue also. 10 lakhs into 1 by 4. So how many bonus shares are given? 2.5 lakh. And this bonus shares are assumed to be there from first day of last year. Which means for bonus issue, I'll consider the period as 12 by 12. Simplify this entire equation. So can I say 80 lakhs is the numerator divided by. So 10 lakhs plus 60. 10 lakhs 60,000. 13 lakh 10,000. So total all that 13 lakh 10,000. And this will give you current year basic EPS. I hope all of you are understanding that. So opening balance will be there for full year. 80,000 will be there for 9 months. And bonus issues also assumed to be there for full year. So based on that, you calculate basic EPS. So can I say basic EPS will be 80 lakhs divided by 13 lakh 10,000. So that will give me 6.11 approximately. And whenever you have a bonus issue in the question, in addition to current year basic EPS, you should also calculate last year adjusted EPS. And when you're calculating last year adjusted EPS, your numerator will be last year Patesh 60 lakh. Take profit available to equity shareholders. Divided by opening balance 10 lakh will be there for entire year. Plus this I'll not take. This bonus issue of 2.5 lakh will be there also for entire year. So we'll assume as if the bonus shares are there in the last year also. So based on that, you calculate adjusted EPS. Can I say 60 lakh divided by 12.5 lakh? and that will give you last year adjusted EPS. So just calculate that. So can I say 60 lakh divided by 12.5 lakhs. So how much you get? 4 rupee 80 paise. This will be last year adjusted EPS, which is whenever you have a bonus issue in the question, we will be calculating three things: last year basic EPS, current year basic EPS. In addition to that, last year adjusted EPS also for proper comparison. I hope all clear. Okay. So with this, we complete the concept of basic earnings per share. Okay. Now let us move on to the concept of diluted EPS. Okay. Now what is the meaning of diluted EPS? See, when I say dilution, can I say EPS is going down? So we are anticipating that EPS is expected to fall in the coming years. Now, when will the EPS fall? What is the formula for EPS? Profit available divided by weighted average number. Now, if the EPS has to come down, either profit has to reduce or gains has to increase. But normally, whenever we are doing business, we assume the profit to remain same now. So nobody will anticipate the profit to come down, which means we anticipate the numerator to remain same. Which means you are anticipating the EPS to reduce not because of reduction in the profit, but because of increase in the number of equity share. Is that clear? Okay. Just when I say diluted EPS, what is the meaning of that? Anticipated fall in the EPS because of expected increase in the weighted average number of equity shares. This is the first thing. But the point you should understand, when there is increase in the number of shares, money also will come. And when money also comes, profit also should go up. When money comes, I'll use the money now. Profit also should go up. And if profit also goes up, gains also goes up, there might not be any dilution only. Which means the number has to go up, but money should not come. So the number has to go up, but money should not come. Then what will happen? Your numerator will remain same. Number will go up. Because of that, EPS will get diluted. And that anticipated fall is what we call as a diluted EPS. Is that clear? So in simple words, a diluted EPS means anticipated fall in the earnings per share because of increase in the weighted average number without increase in resources. Okay, money should not come into the company. Okay, now just look at the definition of diluted EPS. So what is that? It refers to potential fall, nothing but anticipated fall due to what? Increase in gains without increase in resources, which is number should go up, but money should not come in. And there are three possible reasons for dilution. First one, conversion of debentures into equity. So if you're converting debentures into equity share, what will happen to the number? Number of shares will go up, but money will not come. So your numerator remains same, denominator goes up. So what will happen to the EPS? EPS will fall. That is one example. There is one more possibility, conversion of preference shares into equity shares. And finally, this can also be due to options. So we'll be focusing mainly on three reasons: either conversion of debentures, conversion of preference share, or options. Now, what is the meaning of option? See, an option is like you are giving an option to the employees of the company to purchase shares at a price lower than the fair market value. Okay, that is what is called as option. Now, let us try to understand how to calculate diluted EPS in this particular cases. Now, try to understand the formula for diluted EPS. No, don't try to remember, understand this. Diluted EPS. Now, normally what is the formula for basic EPS? Profit available to equity shareholders divided by weighted average number. This is a normal formula. Now, there is a dilution happening because of what? Conversion of debentures or conversion of preference shares or options. So if you are converting debentures, what will happen to the denominator? So can I say denominator goes up? So in denominator, I'll add convertible debentures. Okay. Same way, if you are converting preference shares, again the number of shares will go up. So in denominator, I'll add convertible preference shares. I hope all of you are getting that. So existing weighted average number, to that I'll add convertible debentures, I'll add convertible preference shares. Okay. Now try to understand, when you are converting debentures into equity share, in the next year you need not pay interest now. So if you're converting debentures, debentures will not be there anymore. When debentures are not going to be there anymore, in the next year your profit is going to increase. So since the profit is going to increase, what I'll do, I'll add the interest. I'll add the interest. But now try to understand, when interest is saving, when you're saving the interest, on that whatever interest you are saving, you have to pay tax on that. So if you're saving any interest, your profit goes up now. And when your profit goes up, on that you have to pay tax, which is your benefit is the entire interest or interest net of tax. It is interest net of tax. So in the numerator, I'll add interest into 1 minus tax plus. If you're converting the preference shares, in the next year, you need not pay preference dividend. And when you need not pay preference dividend, your profit are available to equity shareholders will go up. So I'll add what? Preference dividend also I will add. But when I'm adding preference dividend, I should not take any tax impact, because preference dividend comes after the profit after tax. So tax impact should not be given. I hope all of you are understanding that. So what is the formula for diluted EPS? Current year profit available to equity shareholder plus whatever interest you are saving net of tax plus whatever preference dividend you are saving. Take that. And in the denominator, existing number of weighted average number of shares plus the convertible debenture plus the convertible preference shares. In addition to that, in the next year, there are some options also, right? So this particular portion I'll explain directly with the help of some numbers, with the help of an example, so that you understand that better. Okay. Let's take an example. Have a look at the next question. Okay. Look at question number 6. Calculate a basic EPS and diluted EPS. Okay. EBIT is given to you 120 lakhs. Try to understand. EBIT is 120. Interest is 20. So can I say EBIT is 100 lakh? From there, if you remove tax, 30%, so 100 lakhs, 30% if you remove, you get 70 lakhs back. Okay. Number of shares is 5 lakh. Existing number of debentures 20 lakhs, which are pending for conversion in the next year. And what is the ratio of conversion? 1 share for every 4 debentures. Okay. In this example, we have only convertible debenture, no preference shares, no option. So only debentures is there. Now let us try to understand. Now tell me, what is your current year profit available? What is current year profit? Can I say 70 lakhs is PAT? Since there is no preference dividend in the question, so current year profit available is 70 plus. In the numerator, since you are going to convert the debenture, in the next year, you'll be saving interest now. So how much interest you are going to save? See here, what is the number of debenture? Okay, it's given here directly. 20 lakhs is the interest. So I'm going to save the 20 lakhs. Net of tax I have to take, because I'm saving 20 lakhs. On the 20 lakhs saving, I'll pay 30% tax now. Which is out of 20 lakhs, 6 lakhs will go for tax. So effectively, I'll be saving only 14 lakhs. Which is I should take a 20 lakhs into 1 minus tax rate. So in simple words, 20 lakhs into 0.7. Is that clear? Which is in the next year, my anticipated profit is going to be 84 lakhs divided by what is the existing number of shares? Existing number of shares 5 lakh plus in the next year convertible debentures. How much is the what is the rate of conversion here? 1 share for every 4 debentures. So how many debentures are there? 20 lakh. So if you are giving 1 share for every 4 debentures, so 20 lakhs into 1 by 4, how much will be? 5 lakh. So simplify that. So 70 lakhs plus 14 lakhs. So numerator will be 84 lakh divided by denominator will be 10 lakhs. So which means your diluted EPS will be 8 rupee 40 paise. Is that clear? Which is whenever you are converting debenture, in the numerator you should add interest net of tax. This is the point to be kept in mind. Is that clear? Okay. Now have a look at question number 7. From the following information, calculate basic EPS and diluted EPS. Okay. EBIT 200. We have interest 60. So EBT 140. Tax 30%. So 140 in that 30%. 42 if you remove. So 98. 98 lakhs will be packed. Okay. Preference dividend is given if you remove 8 lakh. And that will give you profit available to equity shareholders 90 lakh. Okay. Number of debentures 40 lakhs of 10 each. Okay. Number of preference shares 8 lakhs of 10 each. Next year, both the preference shares and debentures are going to be converted. For debentures, you'll give one share for every 10 debenture, and for preference share, you'll give one share for every 2 preference share. And existing number of shares is 45 lakh. Find out basic EPS, diluted EPS. Okay. See, basic EPS you should be able to do. I'll be directly explaining diluted EPS. Okay. Now, how much is diluted? So we know current year partition is 90 lakhs. So what I'll do in the numerator, I'll take current year 90. In the next year, you'll be converting debentures now. And because you're converting debentures, you'll be saving interest net of tax. So how much is the interest on debentures given here? How much is the interest here? 60 lakhs into 0.7. So can I say 60 lakhs into 0.7. So I'll be saving 42 lakhs. Add that. And in the next year, preference dividend also I should add because I'll not be paying any preference dividend. And how much is the preference dividend? 8 lakh. For preference dividend, you should not take any tax impact. So this will be your numerator divided by what is the existing number of weighted average number of shares? So what is the existing number? 45 lakh. I'll take that. So existing number is 45 lakh plus convertible debenture. Convertible debenture. What is the ratio of conversion? What is the ratio? One equity share for every 10 debentures. So how many debentures are there in the question? Number of debentures. So how many are there? 40 lakh. So for 10 debentures, if I'm giving one share, for 40 lakhs, I'll be giving 4 lakh shares. Correct? So I'll add that. So 45 lakh plus 4 lakh. In addition to that, I should take convertible preference shares also. So how much is convertible preference shares? See that. How many preference shares are there in the question? Number 8 lakh. And what is the ratio of conversion? 2:1. For every 2, you are giving 1. So for 8 lakhs, I'll be giving 4 lakhs. So can I say? I'll add that 4 lakhs also. And simplify this entire thing, and that is going to give you diluted EPS. Which is whenever you have conversion of debentures, you should add interest net of tax. Conversion of preference shares, you should add only preference dividend, ignore the tax impact. And in denominator, you are going to take existing number plus convertible debentures plus convertible preference shares. I hope all of you are getting that point. Is that clear? Okay. So this will give me diluted EPS. Now let us look into the next example. Have a look at the next example here. Okay. Question number 8. Compute basic EPS and diluted EPS. Okay. Basic EPS is straight away 12 lakh by 5 lakh, 2.4. This is basic. Next. In the next year, there are some options. Options are there. The fair value of one equity share is 20. Weighted average number of shares under option. So how many options are given to the shareholders? 1 lakh. And when you are giving options to the shareholder, are you giving it free of cost or concessional rate? Concession. Even though the market value is 20, we are collecting 15 rupees here. So at a concessional rate. Now, observe the things carefully. How do you calculate a diluted EPS? So can I say numerator will be 12 lakhs. Numerator is no change. Divided by what is the existing number of shares? 5 lakh. In the next year, how many options are outstanding? 1 lakh. But I cannot add entire 1 lakh here. That is not right. Because when you are finding out diluted EPS, what is the meaning of diluted EPS? Anticipated fall in EPS due to increase in the number without increase in resources now. Correct? But in our example, 20 rupees is the market value and I'm collecting 15 rupees. So can I say there is a money coming in? And if there is money coming in, numerator also should ideally increase now. Because if you're collecting money, I should use that money. And when I use that money, your numerator also has to go up. But I don't know how much the numerator is going up. So that is the reason in the denominator, I cannot blindly add the entire 1 lakh shares. I should add only the free number of shares. Sir, I should add only free number of shares. Now, how do I find out the free number? Now, try to understand how many options we are giving. 1 lakh. See, market value is 20, but we are giving at 15. So, if the market value is 20, if you are giving at 15, can I say indirectly you are giving a benefit of 5 rupees? So, 1 lakh shares you are giving and benefit is 5 rupees. So, can I say effectively it's like giving 5 lakh worth of shares at free of cost. So, indirectly you are giving a 5 lakh worth of shares at free of cost divided by what is the value of one share? 20 rupees. So, can I say 5 lakh divided by 20? It is as good as giving 25,000 shares at free of cost, which is in denominator. I'm not going to add entire 1 lakh. I'll be adding only 25,000 shares in the denominator. Is that clear? Which means you should take only those number of shares which are given at free of cost. So, in other words, okay, try to understand and remember. What I'll simply do, 12 lakh divided by existing number is 5 lakh plus number of options 1 lakh into discount divided by fair market value. What is the discount here? Fair market value is 20. We are giving at 15. So I'll take 5 rupee discount in the numerator, 20 rupees in denominator. That's what will give you 12 lakh divided by 5 lakh 25,000. Simplify that and that will give you diluted EPS. I hope all of you are getting that. Is that clear, guys? Okay. So now let us consolidate all this into one particular formula so that diluted EPS is done. So can I say diluted EPS equal to current year profit available to shareholders plus, if you are converting any debentures, you should add what? Interest but net of tax. If you are converting any preference shares, what you should do? Add preference dividend divided by what should be the number? You should take existing weighted average number of shares. To that, what should I add? Convertible debentures plus convertible preference shares. In addition to convertible preference shares, what am I going to add in the denominator? Convertible preference shares plus options into discount divided by fair market value. I hope all of you are understanding. So what I'll do? Convertible preference shares plus options into discount divided by fair market value. This entire equation will give you diluted earnings per share. I hope all of you are understanding. There's nothing to mug up here. Just understand the concept and apply that. Okay. So with this, we have completed the concept of diluted earnings per share. Yeah, let us move on to the next concept in accounting standard 20. If there is right shares involved in the question. Okay. Yeah, let us move on to the next concept. If you have right shares involved in the question, then how do you calculate EPS? Can I say whenever there is a right issue of shares, you are issuing the shares at a price less than the market value? Because it's an option given to the existing shareholders to buy the shares at a price less than the market value. And if I'm giving the shares at less than the market value, can we say there is some bonus element involved? And whenever there is a bonus element involved, we assume that this bonus element is there from the first day of last year. And whenever there is a bonus element from the first day of last year, we are supposed to calculate current year basic EPS. In addition to that, we need to calculate last year adjusted EPS, correct? Which means whenever there is right shares in the question, in addition to current year basic EPS, we must calculate last year restated EPS also, because in case of right issue, there is going to be certain bonus element involved. Now, so whenever you have a right issue in the question, there are 4 different calculations we'll be doing. Let's go through the question first. Your current year profit 90 lakhs. Last year profit is given to you 80 lakhs. Number of shares at the beginning we have 10 lakhs. Exactly in the middle of the year, right shares were given at a price of 15 when the market price is 25. And what is the ratio? 1 for every 4. So for 10 lakh shares, so 10 lakh into 1 by 4. So how many right shares will be given? 2.5 lakh. calculate basic EPS and adjusted EPS. Okay. Now, whenever there is a right issue in the question, there are four working notes you'll be doing. First thing, let us try to find out the bonus element involved. So how do I get the bonus element? Bonus element equal to fair market value of the share divided by theoretical ex-right price. And when I say theoretical ex-right price, this is the price of a share which is theoretically going to be after the right issue. See what happens here. Whenever you make a right issue, you'll be collecting less than the fair market value. And since you're collecting less than the fair market value, logically, what will happen to the value of one share? The value of the share will come down. Let's take an example. Let's say, right now, the wealth of a person is 10 lakh. Wealth of a person is 10 lakh. And this person is getting married and is getting a wealth of 8 lakhs, additional wealth, 8 lakh. Now, after the marriage, there will be two people now. Because of that, per person, the wealth is going to reduce and become 9 lakh. Instead of 10 lakh rupee wealth, his wealth is going to become 9 lakh, correct? Same logic, when I do right issue, you are doing the right issue at less than the market value. And since I am doing it less than the market value, theoretically, the worth of the share will come down. And that is what is called a TRP. So now let us find out TRP. So the TRP equal to, how do you find this? Existing number of shares. So how many shares are there in the question? 10 lakh into fair market value. So what is the market value of the share? 25. So can I say this is the wealth of the company right now? 10 lakh into 25. That is the worth of the company right now. Plus new shares. How many new shares are going to be given? 2.5 lakh into issue price. What is the issue price here? 50. So existing number of shares into the market value plus number of right shares into the issue price divided by after the right issue, how many shares are going to be there totally? 12.5 lakh. And that is what is going to give you theoretical value of one share. It's a simple point. You have to understand that. So 250 lakhs is the wealth right now. This is the additional wealth. So when I say total wealth of the company divided by number of shares will give you theoretical value of one share. So just find out that. So that will give you TRP. So can we say 250 lakhs plus 37.5. So 287.5 divided by 12.5 lakhs. Correct. 287.5 divided by 12.5 lakhs. And that should give you 23 rupees is the theoretical ex-right price. Now you find out the bonus element. So how do you find that? Fair market value divided by TRP. What is the fair market value of one share? 25 divided by theoretical ex-right price is 23. So can I say bonus element will be 25 by 23, 1.09 approximately. Is that clear? So first you find out TRP, then you find out bonus element. Is that clear? Next thing. This bonus element, as per accounting standard 20, is assumed to be there from the first day of the previous year, correct? So what I'll do, you'll find previous year variance. Previous year weighted average number of equity shares. And why I need the previous year variance? Because I need to calculate a restated EPS of last year. For that purpose, I'll calculate a previous year variance. So what I'll do, I'll take the number of shares in the last year, that is 10 lakh, into this bonus element is assumed to be there in the entire year. So 10 lakhs into 1.09. So the previous year variance is going to be 10 lakh 90,000. This is the number of shares which I will consider for the purpose of adjusted EPS, restated EPS. Okay. The last working note, you need to find out current year variance. First we found out TRP, then bonus element, then the previous year variance, and finally current year variance. Now, how do you get the current year variance? Understand the logic here. Number of shares at the beginning. How many shares are there in the beginning? 10 lakh into bonus element 1.09 into number of months before the right issue. How many months are there before the right issue? See, right issue is happening exactly in the middle. So the number of months before right issue will be 6 months. So 6 by 12. Okay. Plus Total number of shares after the right issue. So after the right issue, totally how many shares are there? Can I say 12.5 lakh? A 10 lakh beginning plus 2.5 lakh extra. 12.5 lakh. Now this 12.5 lakh already includes the right issue now. Now don't multiply with the bonus element. Into number of months after the bonus issue divided by 12. Okay. Simplify this entire equation. That is going to give you current year weighted average number of equity shares. Okay. So if I simplify all this, can I say 10 lakh 90 into 6 by 12 will give you 5 lakh 45,000 plus 12.5 lakh into 6 by 12 will give you 6 lakh 25,000. So add these two and that will give me 11 lakh 70,000. And this will be your current year wins. I hope all of you understand. Is that clear? Okay, I hope all of you got that current year wins calculation. I'll just explain the logic also behind the formula. Okay. If you see here, there is a bonus element of 1.09. What is the meaning of that? 10 lakh into 1.09. So this 90,000, whatever you got, that 90,000 is like bonus shares. Okay. Now, what is the total right issue? 2.5 lakh. Out of 2.5 lakh right issue, 90,000 shares are treated like bonus. Remaining 1.6 lakh shares are treated like fresh issue. Try to understand the logic. 90,000 is like bonus and 1.6 lakh is like fresh issue. So this 90,000 bonus shares are assumed to be there from first day of last year. But this 1.6 lakh shares are like a fresh issue that is there only for 6 months. Now, if you apply the formula, if you see here carefully, 10 lakhs into 1.09 when I take, I'm taking 10 lakh 90. This 10 lakh 90,000 includes a 10 lakh rupee opening balance, 90,000 bonus issue. Okay. So I'll try to explain the logic also behind the formula. Try to understand that. Now, in our example, bonus element is 1.09. When I say 1.09, so when I multiply 10 lakh into 1.09, getting 10 lakh 90. See, this extra 90,000 is treated like bonus element. Now, what is the total right issue that you have done? 2.5 lakh. Out of the 2.5 lakh, 90,000 is like bonus shares. And remaining 1 lakh 60,000 is like fresh issue of shares. Because you're collecting money now. So 90 is like bonus, 1.6 lakh like fresh issue. Now, in our question, opening balance of shares is 10 lakh. This 10 lakh I should take for full 12 months. So 10 lakh into 12 by 12. Correct? 10 lakh into 12 by 12. Next, we have bonus shares. So bonus shares also I should take 90,000 into 12 by 12. But however, this fresh issue 1.6 lakhs, I should take only for 6 months. If I simplify all that, can I say 10 lakh plus 90,000 plus 80,000. So effectively, what is the current year means? 11.7 lakh. Now that is what I have put in the form of formula. If you observe here properly, this 10 lakh 90,000 is there for full year. And 1 lakh 60,000 is there only for 6 months. Correct? If you see here, 10 lakh 90,000 is there in this 6 months also. And this 12.5 lakh also include 10 lakh 90,000 and which is there for this 6 months also. So can I say effectively 10 lakh 90,000 is there for the entire year and 1 lakh 60,000 is there only for 6 months. I hope you're getting the logic here. So this is how the formula is derived, but I just want you to just remember from examination point of view. So just calculate that and that will give you current year wins. Is that clear? 11 lakh 70. Which is whenever there is a right issue in the question, 4 calculations you will do. What are the 4 calculations? Theoretical ex-right price. Then you find out bonus element, previous year wins, current year wins. And once you find out all that, now let us calculate whatever is asked in the question. Now what are you have to find out? What are you have to find out? First, let us find out last year basic EPS. So can I say last year basic EPS? Nothing but last year profit, how much? Last year profit is 90 lakhs divided by last year wins, 10 lakh. They'll give you 9 rupees. Next, you have to take current year basic EPS. For current year basic EPS, what should I do? Current year profit 80 lakh divided by current year wins that we calculated now 11 lakh 70. Do that, then give you current year EPS. In addition to that, you should also calculate last year adjusted EPS. And how do you get that? Last year profit 90 lakh divided by previous year wage that you have recalculated 10 lakh 90,000. Do that. That will give you last year adjusted EPS. Which is whenever there is a right issue in the question, first you need to do 4 working notes. You find out theoretical exit price, bonus element, last year wage, current year wage. And once you find all that, then you find out last year basic EPS, current year basic EPS, and last year adjusted EPS. I hope all of you are getting that. Okay. So with this, we are done with a quick summary of accounting standard 20. Yeah, let us move on to the next accounting standard, AS 28, impairment of assets. See, when we say impairment, can I say asset values going down? And normally, asset value, if it goes down because of wear and tear, passage of time, or obsolescence, we call it as depreciation. But if the asset value is going down because of any reason other than depreciation, then we call it as impairment. So let's say I have got a asset, one machine is there which I bought for 1 lakh, and there is a fire accident in my factory, and because of that, can I say the machine value comes down? And when the machine value comes down, I cannot call it as depreciation, that becomes impairment. Similarly, let's say I purchase one land. I'm paying 10 lakh rupees, I bought a land. Currently, that land is under some litigation. Because of that, the market price of the land will come down. And if the market price of land is coming down, I cannot call it as depreciation, that is called as impairment. Which means impairment means asset value is going down because of reasons other than depreciation. Is that clear? Now, what are the different reasons which can lead to impairment? There can be significant reduction in market price due to other reasons. Okay. Physical damage of asset, poor performance of the asset, all this will result in impairment of the asset. Now, where is this accounting standard 28 is not applicable? See, AS 28 is not applicable if there is a fall in the value of inventory. Because if the inventory falls, will value at cost or NRV, whichever is lower, but that is covered under accounting standard 2. So AS 28 does not deal with inventory. Same way, if there is a fall in the value of investment, that will be dealt under accounting standard 13. Any construction contract will be covered under accounting standard 7, and deferred tax asset is covered under accounting standard 22. And these items are specifically excluded from the scope of AS 28. Okay. Now, in this entire accounting standard, the most important topic is this only. Okay. When the asset is said to be impaired. So this is our main focus going to be. So let us try to understand this with the help of a flow chart. So when the asset is said to be impaired. So if the carrying amount of the asset is more than recoverable amount of the asset, then we will say that asset is impaired. So what should I compare? Carrying amount, recoverable amount. So if we are carrying the asset at more than the recoverable amount, we can say the asset is impaired. Now, what is the meaning of carrying amount? Carrying amount is nothing but, can I say, book value? Book value. Sir, how do you find out the book value of an asset? Can I say original cost minus accumulated depreciation till now, plus or minus a revaluation as per accounting standard 10. And that will give you carrying amount of the asset. So let's take an example. Let's say original cost of the machine is 5 lakh. Accumulated depreciation till now is 40,000. And in the previous year, we have done downward revaluation of 25,000. So cost minus depreciation minus downward revaluation, and this will give me 4,35,000, and this is called a carrying amount. This carrying amount you need to compare with a recoverable amount. Now, what is the meaning of recoverable amount? For that, you need to find out two things. One is net selling price. Now, what is the meaning of net selling price? This is something similar to NRV, net realizable value. Now, I have a machine with me. This machine, if I sell it in the market, the expected selling price of the machine, let's say 5 lakh. And to sell the machine, I have to incur some dismantling cost, brokerage, commission, etc. So the estimated selling expenses, dismantling cost, all that put together, let's say 10%. So which I have to pay 50,000. So 5 lakh minus 50,000. What is the net selling price of the asset? 4.5 lakh. So net selling price of the asset is 4.5 lakh. So if I sell the asset in the market, so what is the net amount that is going to come into my pocket? 4.5. This net selling price I should compare with value in use. Okay. What is the meaning of that? Sir, if I sell the asset, I'll get 4.5 lakh. That is net selling price. If I use the asset, how much I'll get? That is value in use. So let's say if I use the asset for the next 3 years, the remaining life, let's say 3 years. So for the next 3 years, 1, 2, 3, we are anticipating cash flows of 2 lakh rupees every year. So 2 lakh, 2 lakh, 2 lakh. So these are the cash flows I'm expecting for the next 3 years. And let's say discounting rate is 10%. Can I say this future economic benefits are in the future value? 2 lakh, 2 lakh, 2 lakh is the future value. So you need to find out the present value of the future economic benefit. Find out that. So 10% you find out. So can I say 2 lakhs into 0.909, 2 lakhs into 0.826, 2 lakhs into 0.751. Simplify all this, total that, and that will give you value in use. Is that clear? Okay. So in simple words, value in use is nothing but if you use the asset, how much you are expecting. And that you have to convert into present value and total all that. So can we say in our example, it's going to be just find out the value in use. So 2 lakhs into 0.909. So can I say 1 lakh 81,800 plus 1 lakh 65,200, 1 lakh 50,200. Add all that, that is going to give you value in use. So can I say 181,800 plus 165,200, 150,200. So 4 lakh 97,200. Now, understand this carefully. If I sell the asset, I'll get 4.5. If I use the asset, I'll get 497,200. So if that is the case, you'll prefer to sell the asset or you'll prefer to use the asset. So definitely I'll prefer to use the asset, which is in that case, my recoverable amount is going to be 4,97,200. Correct? But let us say net selling price is 5 lakh. In that case, it's better to sell the asset or better to use the asset. Then it is better to sell the asset, which means a recoverable amount should be logically net selling price or value in use, whichever is higher. So I'll compare both and take whichever is higher. And that figure is called a recoverable amount. So in our example, your recoverable amount will be 4,97,200. Now, is the carrying amount greater than recoverable amount or lower than recoverable amount? Lower. Sir, in my balance sheet, we are showing at 4,35,000. But the recoverable amount is 4,97,200. So I can recover more than what I'm showing in my balance sheet. So is the asset impaired or not impaired? So can I say it's not impaired? So in this example, there's no impairment loss. When we will say there's an impairment loss? If you are carrying the amount, let's say instead of 4,35,000, let us say your carrying amount is 6 lakh. Then what you will do? So carrying amount is 6 lakhs, whereas recoverable amount is 4,97,200. So you are showing in the balance sheet at 6 lakh, but the real worth is only 4,97,200. So the difference between carrying amount and the recoverable amount will be called as impairment loss. So can I say impairment loss is nothing but carrying amount minus recoverable amount. So what is carrying amount here? 6 lakh minus recoverable amount is 4,97,200. So you get 1,02,800 impairment loss. Is that clear? But as per our original example, there is no impairment loss. I've changed the example just to explain you the concept of impairment loss. I hope all of you are clear. Okay. So the final conclusion, if your carrying amount is more than recoverable amount, we can say that asset is impaired. And what is the meaning of recoverable amount? Net selling price or value in use, whichever is higher. Is that clear? And what is the meaning of value in use? That is nothing but the present value of the future economic benefits. Is that clear? Okay. So this is how you find out impairment loss. Okay. Now, let us try to understand how to do accounting for impairment. So let us take the same example. In our example, how much was the carrying amount? 6 lakhs. I've changed the example and we got recoverable amount which is 4 lakh 97,200 So the difference is 1 lakh 2,800. This is called as impairment loss. Now, how do you do the accounting for impairment loss? So can I simply say impairment loss is a loss for you, debit that. Asset is going down, credit that. So impairment loss account debit to asset account. And this impairment loss I will transfer to P&L account. So the second entry is going to be P&L account debit to impairment loss. I hope all of you are clear. So this is how you do accounting for impairment. So impairment loss account debit to asset account, P&L account debit to impairment loss. Example number 1. Now, we'll take up one more example, very, very important. Focus carefully. Example number 2. Let us say you bought the machine for 10 lakhs. Cost of the machine 10 lakh. Life of the machine 10 years. So can I say 1 lakh depreciation for 1 year? At the end of third year, the asset is revalued, let's say at 7 lakh 70,000. Okay, 7.7. Now can I say original cost is 10 lakh. 3 years is over, so 3 lakh rupee depreciation gone. 7 lakh should be the book value. But at 7 lakh asset, we are revaluing at 7.7 lakh. So can I say there is one upward revaluation happening? Correct? Upward. How much is the upward revaluation? 70,000. Because of which your asset value is going to become 7 lakh 70,000. Correct? 7 lakh 70. Now, because the asset value is going up, from next year onwards, my depreciation also will increase. 7 lakh 70,000 divided by what is the remaining life? 7 years. So depreciation will be 1.1 lakh. Correct? Now let us say fifth year ending. At the end of fifth year, the recoverable amount of the asset is given to you. Recoverable amount of the asset, let's say, is 4 lakh. Now, how much is the impairment loss? Now, try to understand. 7 lakh 70,000 is the book value when third year ending. But I'm giving you a recoverable amount when fifth year ending. So, what I'll do from here, I'll remove depreciation for year number 4 and year number 5. So, how much will be your depreciation? 7 lakh 70,000 divided by remaining life is 7 years. So 1 lakh 10,000, 1 lakh 10,000. So 110 into 2 years, so 2 lakh 10, so 2 lakh 20. So from 770, I'll remove 2 lakh 20,000. So what is the carrying amount right now? 5.5 lakh. This 5.5 lakh is the carrying amount. But what is the recoverable amount right now? 4 lakh. So 5.5 is my carrying amount, whereas the recoverable amount is only 4 lakh. So can I say the difference of 1.5 lakh is my impairment loss? Is that clear? So 1.5 lakhs is your impairment loss. Now, how do you do accounting for that? So what we do here, we'll take impairment loss account debit 1.5 lakh to asset account 1.5 lakh. Next entry, we will not transfer the entire impairment loss directly to the profit and loss account because in the last year you have done upward revaluation. Sir, when you have done upward revaluation, whatever excess amount you have got, the entry would have been asset account debit to revaluation reserve. Correct? I would have opened a revaluation reserve, which means whenever there is impairment loss, that loss has to be set off against a revaluation reserve first. So what I'll do now? First, I will debit a revaluation reserve account. So how much is the balance available in there? 70,000. Remaining 80,000, I'll set off against P&L to impairment loss. So the point you need to understand, whenever you have revaluation reserve with you in the question, impairment loss will be set off against RR first. The balancing figure only will be transferred to P&L account. Don't put the entire amount in P&L account. Is that clear? Okay. So whenever you have impairment, always set off using revaluation reserve first. Is that clear? Okay. Now, let us change this example number 2 slightly and understand one more concept from here. Let us change the example number 2 slightly. In the same example, let's say it's given in the question, additional depreciation due to revaluation is adjusted against revaluation reserve. Like that, one point is given in the question. So the additional depreciation due to revaluation is adjusted against revaluation reserve. See, this entire calculation is going to be same, no difference. So carrying amount, how much? 5 point, the same calculation. But now what they're telling, whatever additional depreciation because of the revaluation is adjusted against RR. Now in this example, if there is no revaluation, can I say depreciation is 1 lakh every year? But because of revaluation, depreciation became 1 lakh 10,000. So what is the additional depreciation? 10,000 per annum. So 10,000 per 1 year. So for year number 4 and year number 5, so can I say 10 and 10, 20,000 extra? And that 20,000 extra depreciation, they are telling you is adjusted against RR, which is out of 70,000 RR, 20,000 is already adjusted. Okay, 20,000 is already adjusted, which is in third example, how much will be left in revaluation reserve account? 70,000 will be there or 50,000 will be there? 50,000. Because out of 70, 20 is already adjusted. So now in example number 3, so the entry will be, first entry is same. So impairment loss account debit to asset 1.5. This will not change. But when you pass second entry, revaluation reserve 70,000 will not be there. Out of 70,000, already 20,000 additional depreciation is gone. So RR will be 50. P&L account will be utilized 1 lakh to impairment loss 1.5 lakh. This is how you do accounting. Is that clear? See, this additional depreciation adjustment you should do only if it is specifically mentioned in the question. Otherwise, do it like example number 2. Is that clear? So this is how we do accounting for impairment losses. Okay. So we'll continue to the next concept. The next topic of phase 28 is cash generating unit. Now, what is the meaning of this cash generating unit? So let us say I'm running an academy. So if I'm running an academy, to generate cash flows, I'm using multiple assets together. Let's say I'm using one laptop, I'm using one iPad, I'm using some mic. So I'm using all the assets together to generate cash flows. This entire group of assets which is used together is what we call as a cash generating unit. Is that clear? Now let us say in my example, I have one mic, laptop, iPad, all the three put together I should use together in order to generate cash flows for the academy, correct? So cash generating unit is the smallest identifiable group of assets which generate independent cash flows. Now let's take some example to understand this. Let's say we have 4 different machines, so machine number 1, 2, 3 and 4. The carrying amount is given to you as 10, 20, 30, 40. So what is the total carrying amount? 100. Now in this example, if I sell all the 4 machines put together, the net selling price of the cash generating unit, let's say 85 lakh. Clear? And if I use all the machines together, I'll get the cash flows. So I cannot use the machine independently. I have to use all the machines put together. And if I use all the machines put together, the value in use of the entire group, let's say 90 lakh. If I compare NSP and value, whichever is higher, can I say recoverable amount is 90 lakh? So carrying amount is 100, whereas recoverable amount is 90. So carrying amount minus recoverable amount is an impairment loss of 10 lakh. And this 10 lakh rupee impairment loss will be spread to all the 4 machines in the carrying amount ratio. And what is the carrying amount ratio here? 1 is to 2 is to 3 is to 4. So the 10 lakh impairment loss will be put on all the 4 machines. So can I say the entry will be impairment loss account debit 10 lakh, and that 10 lakh will be spread across machine number 1, machine number 2, machine 3 and machine 4 in 1, 2, 3, 4 ratio. So can I say 1 lakh, 2 lakh, 3 lakh, 4 lakh. Is that clear? Which is whenever there is a CGU, the impairment loss will be spread to all the assets of the CGU in the ratio of carrying amount. All of you are clear with example number 1? Okay. Now let us move on to the next example. Example number 2. So if you look at next example, we have got 4 machines. Carrying amount is given to you 10, 20, 30, 40, total 100. Sir, can you sell the machine separately in the market? Possible, right? You can sell machine 1 separately, 2 separately, 3 and separately and 4 separately. And if you sell that, you're expecting NSP of 20, 20, 20, 20. So what is the total NSP of the entire group? 80. But can I use the machine separately? You cannot, because you have to use all the machines together to generate cash flows, which is I cannot find out the value in use separately, but I know the value in use of the entire group, let's say 90 lakh. Okay. Now, can I say the recoverable amount of the group will be whichever is higher, 90. So carrying amount is 100, recoverable amount is 90. So can I say there is an impairment loss of 10 lakh? Now in this example, the 10 lakh impairment loss, how will you spread it? Now observe this carefully. If you look at machine number 1 and machine number 2, sir, even if I assume value in use as 0, I don't know, na? So even if I take it as 0, can I say in these two cases, net selling price is 20 and 20. So the recoverable amount is going to be 20 and 20. And in these two cases, the carrying amount is lower than the recoverable amount. And if carrying amount is lower, and in second case, carrying amount is equal. So machine number 1 and machine number 2, there is no impairment only. So if there's no impairment in machine number 1 and machine number 2, this impairment loss of 10 lakh will be put only on third and fourth machine, because it is not fair to put the loss on first and second machine. Because in first and second machine, carrying amount is either less than the recoverable amount or equal to recoverable amount, which means this 10 lakh impairment loss will be debited, and that will be credited only to machine 3 and machine 4, in which ratio? Carrying amount ratio, that is 3:4. I hope all of you are understanding that. Which is whenever NSP is given separately, you need to verify individually whether the machine is impaired or not. And in this example, only third machine and fourth machine is impaired. So 10 lakh is going to be spread in the ratio of 3:4. Is that clear? Okay. One last example. Let's say we have 4 machines, M1, M2, M3, M4. And the carrying amount we know 10, 20, 30 and 40, total 100. And let's say machine 2 is physically damaged because of some accident in the factory. But even though it got physically damaged, still the machine is in working condition, let's say. Okay. The net selling price of the entire group, 110 lakh. Value in use of the entire group, let's say 105 lakh. So whichever is higher, so your recoverable amount will be 110. Carrying amount is 100. Recoverable amount is 110. So carrying amount is less than recoverable amount. Which is, if carrying amount is less, can I say there is no impairment? Which means even though the second machine is physically damaged, still there is no impact on the performance of the entire group. So if there is no impairment in the entire group, even though machine 2 is physically damaged, you need not book any impairment loss. Which is, in this particular example, I need not recognize any loss for machine number 2, because there is no impairment in the group. So the point to be kept in mind, if there is no impairment in the CGU, you need not recognize impairment loss for individual asset. Is that clear? So with this, we are done with a quick summary of Accounting Standard 28. Yeah, that's all for today, guys. So in the yesterday's marathon video, I've already tried and covered 12 accounting standards. In today's video, we have covered 3 accounting standards. In addition to that, I've uploaded separate videos for Accounting Standard 7, Accounting Standard 19 and Accounting Standard 22. So with that, totally 18 accounting standards I've tried and revised it. Okay, other accounting standards, I've anyway shared the material, you can go through that. So with that, so whatever possible from my end, I've tried and covered it. So hope whatever revision I've done is helpful for you guys. So if you have benefited from this particular video, so definitely please let me know. So in the comment section, I'll be waiting to hear from you. So if you've really understood whatever I've taught, and if you're finding this video helpful, please share with your friends and in the comment section. So please let me know that it is helpful for you. So that will motivate me more and I'll do more videos for you guys. And definitely that is going to help you in the long run. Thank you.